Silver just blew the lid off the level the banks have defended for months. It spiked hard, ripped higher in seconds, and then snapped back down just as fast. And I know exactly what that pullback does to your nerves, because this is the moment most people get shaken out. You see the dip and your brain whispers, was that it? Is this another fake out? Are they about to shove it back under the ceiling and make everyone look stupid? Stop and listen carefully. This is not a crash. It is not a failure. It is the most important technical behavior a market can show you after a breakout. It is called a retest. And in this market, the retest is the difference between a headline and a regime change. In this deep dive market update, we are going to analyze the anatomy of what just happened. We will explain why the price shot to 66.50 so fast. We will break down the gamma squeeze that forced the banks to buy against their will. We will talk about the whale that is still holding the line. Then we will talk about the fuel, bank capitulation, and the signal to watch. Finally, we will step out of Wall Street and into the physical world, because that is where the real price is already being paid. The wall at 65 has fallen. Now we have to defend the rubble. Why silver teleported higher, gamma. And to understand that vertical line, you have to understand the plumbing. You have to understand gamma. Gamma is an options term. It measures how fast a market maker's risk changes as price moves. Think of the market maker as the house in a casino. The house sold a mountain of call options at the 65 strike. Those calls are bets that silver will rise. As long as silver stayed below 65, the house looked safe. The options decayed. The house collected premium. But the moment price crossed 65, the math flipped. The risk did not rise slowly. It rose exponentially. The closer you move through the strike, the more the hedge requirement accelerates. So the risk model screamed danger, and the computer hedged. It started buying futures. Not because the bank suddenly believes in silver, not because it joined your team. It bought because it had to protect its book. Here's the trap. Their hedging pushes price higher. Higher price increases their exposure. More exposure forces more hedging. More hedging pushes price higher again. It becomes a feedback loop that feeds on itself. That feedback loop is the gamma squeeze. You have seen the same engine before. It is the same basic mechanic that drove GameStop into the stratosphere in 2021. In that moment, it is not fundamentals. It is not a careful debate about supply and demand. It is math. It is forced buying. This morning, that math broke the banks. The spike to 66.50 was algorithmic panic buying into a vacuum. There were no comfortable sellers waiting at the ceiling. There were machines trying to buy now before they got blown up. So why did it stop? Because humans stepped in. Traders saw a vertical move and they took profits. The gamma buying exhausted itself as the hedging stabilized. And now we return to reality. But the damage is done and the message is clear. 65 is not a roof anymore. The retest, roof, becomes floor. For months, 65 was a concrete ceiling. Today we broke through the roof. Now we are standing on top of it, and the market is stomping to see if it holds. That is what this pullback is. The market is testing the new floor. Here is the rule. We need to see buyers step in and hold price above 65 into the close. If we stay above it, 65 becomes the price you buy at, not the price you sell at. That is how a ceiling becomes a floor. But discipline matters. If we fall back below 65 and close down in the 64 zone, that is a fake out. Failed breakouts can crash hard because breakout buyers become trapped and they rush out together. So 65.80 is a battleground. We are in the buffer zone. Do not celebrate yet. Watch the close. Watch whether the old roof can truly support the weight of the new price. Right now, we are in what I call the buffer zone. We are above the danger line, but close enough that the close matters. If we close strong above 65, the breakout story gets confirmation. If we close weak and slip back into 64, that is when the headline turns into a trap. So you do not need to predict the next 10 cents. You just need to respect the levels and let the market tell you which path it chose. This is why I am not panicking about the pullback. A retest is the market proving something, and it is the market saying we are not going back inside the cage. We are building a platform outside the cage. The whale is still here. Remember the whale we talked about? the mystery buyer who reportedly absorbed around $650 million worth of silver near 63. Everyone asked, did they sell into the spike? Did they vanish? When the price fell from 66.50 into the 65.70s, massive block bids appeared. Somebody stepped in around 65.75 and said, I will take it. That matters because it is not what a tourist does. Speculators sell into strength. They chase candles and they cash out when they get a quick win. This buyer did the opposite. They supported weakness. They put a floor under the market to prevent a collapse back below 65. Last week, 63 was cheap. Today, they are willing to pay up. They are defending the breakout. A whale does not put that kind of money to work to scalp a few cents. They do it because they see the next chapter. They see what happens when a critical level breaks and holds. If 65 holds, the next target is not 66. It is 70 and then higher. So when you see 65.80, do not read it as failure. Read it as consolidation. Read it as reload. The gamma squeeze was the spark. The next phase needs fuel. The fuel is bank capitulation. In the silver market, the fuel is the commercial short seller. For decades, bullion banks sold paper into rallies and bought it back on dips. They acted like the governor on the engine. They kept the speed limit where they wanted it. They could dump paper, trigger stops, and convince everyone the ceiling was real. But the governor broke when price crossed 65. At that point, the math of their position changes from profitable to catastrophic. And when a bank is forced to close a short, it becomes the most bullish buyer in the universe. It buys because it needs out. It does not care about a good entry. It cares about survival. Do the math on the trap. One of the cleanest windows into positioning is the commitment of traders report. It tells you who is long and who is short. The commercial category, basically the bullion banks, is historically net short. The numbers have that net short around 80,000 contracts. One contract is 5,000 ounces. That is roughly 400 million ounces. 400 million ounces of paper promises. When you are long, the worst case is 0. When you are short, the risk is infinite. If silver goes to 100, the short owes that move. If it goes higher, the short owes that too. There is no ceiling. So risk managers wake up. Credit tightens, margin rises, the game changes. Normally when silver rises, they add shorts to cap it. But when the position is too large and financing is too tight, they cannot press. They have to cover. And to cover, they have to buy. That forced buying creates a super bid under the market. Every dip becomes a chance to exit. Every exit pushes price higher. This is why short covering is rocket fuel. It is not optional demand, it is desperate demand. The smoking gun, open interest. How do we know if this is real capitulation and not just another setup? We watch open interest. Open interest is the total number of open futures contracts. In a normal rally, price rises and open interest rises. In a short squeeze, price rises while open interest falls because shorts are closing and leaving the casino. So when the exchange prints the numbers, watch them. If price is holding around 65.80 and open interest drops meaningfully, that is the smoking gun. It means the rally was driven by the permanent sellers exiting. And if the permanent sellers are gone, who is left to sell? Here is the practical way to read it. If price is up and open interest is down, shorts are closing. That is capitulation. If price is up and open interest is also up, that can mean fresh longs, but it can also mean fresh shorts stepping in to fight the move. And that is the difference between a controlled climb and a squeeze that starts to run. So tonight and tomorrow, I am watching 3 things. The daily close relative to 65, the change in open interest, and the behavior of premiums in the real market. Those 3 together tell you whether this is just noise or whether the structure is tightening like a spring. But I have to warn you, banks are wounded animals. Before they fully capitulate, they may try one last Hail Mary. They may dump paper in the middle of the night to trigger stops and scare you because fear creates liquidity, and liquidity is how they escape. So if you see a sudden drop, do not automatically assume the rally is over. Assume it is an attempt to manufacture exit liquidity. Capitulation is a process, not one candle. Paper versus physical, the shadow price. Now we step out of the paper arena and into the real world. Turn off the screen and pick up the phone. Call a refiner. Try to buy a monster box. Try to source industrial material. You enter a different reality. While the paper market fights to keep the quote under the mid-60s, major industrial users are quietly paying $70 or more just to secure delivery. That is the shadow price. It is the price Samsung pays to keep a factory running. It is the price a mint pays to get blanks. It is the price that matters when the question is not what is the quote, but can you actually get the metal? Why pay 70 when the screen says 65? Reliability. Imagine you run a solar panel factory. Your line costs $1 million an hour. If you run out of silver paste, you lose millions. Your supplier says, we can deliver at the COMEX price in 3 weeks, or you can pay 70 and we ship today. You pay 70. Every time. Because the premium on metal is nothing compared to the cost of stopping production. We are already seeing reports of premium buying ripple through the supply chain. Electronics manufacturers do not want to be the last one calling the supplier, so they bypass the exchange entirely. They go directly to the mines. They go directly to the refiners. They offer cash bonuses to jump the line. None of that shows up on your chart right away, but it pulls real metal out of the system. It turns deliverable inventory into private contracts. And that is how you go from a market that looks balanced on a screen to a market that is empty in the real world. This creates a shadow market. Industry bypasses the exchange, goes directly to mines and refiners, and pays to jump the line. The volume leaves the exchange quietly, and physical inventory drains. Then one day the disconnect snaps. The spot price gaps up to meet the shadow price. The screen is lying. The invoice is telling the truth. Retail is the canary, and you need psychological armor. Look at retail premiums. Normally when spot rises fast, premiums compress because dealers want to move inventory. But right now, spot is up and premiums are up. Dealers are scared they cannot restock. So they raise premiums, widen spreads, and switch to pre-orders. Ships in 4 weeks is a polite way of saying they do not have the metal today. This is also why you will see dealers change their behavior in real time. One day you have in stock, the next day you have pre-order, then you have limit 2 per customer. Those are not marketing tricks. Those are stress signals. And if the price moves fast enough, some dealers will choose the easy way out. They will refund you at the old price and say they could not source the metal. That is not a conspiracy. That is a business surviving a squeeze. If spot jumps while you are waiting, you might get refunded instead of delivered. You get your cash back, but you miss the move. That is how a paper quote can look calm while the physical market is on fire. This is also why you need psychological armor. Price discovery is chaotic. It will shake you. There will be sharp up days and brutal down days. The market will try to bully you out before the real revaluation. So set rules. Watch the structure, not the noise. If the retest holds and the deeper support is intact, pullbacks are not the enemy. They are the launch pad. And remember the end game. Exit is not cash. Exit is a swap. Later, when the ratio compresses, you swap silver into gold or real assets. You trade volatility for stability. Final recap. Wednesday, December 17th, 2025. We will look back on this day as a tipping point, the day the banks lost control, the day the 65 wall fell. The genie is out of the bottle. You cannot put the toothpaste back in the tube. The world now knows silver is scarce. They know the price was suppressed, and they are rushing to get a seat at the table. You are already seated. Now your job is simple. Do not move. Do not sell. Let the market come to you. The squeeze has just begun. Hold fast.